Today on The Bottom Line, what really matters for Netflix, Alibaba CEO reveals another hidden talent, and why BlackRock's chief investment strategist is still bullish on U.S. equities.
Hello, everyone. Welcome to The Bottom Line. I'm Henry Blodget. We had new highs in the market this week, and Sarah has found a strategist who says it's just the beginning.
Yeah, we have BlackRock Global Chief Investment Strategist Richard Turnell, who says we're just in the middle of this huge economic expansion, and there's still a lot of room to run.
Netflix hits a new high above 200, forcing us to rapidly revisit our how high can it go perspective, and the dancing CEO has now taken up singing. Let's start with Netflix. Netflix reported a blowout quarter this week. Stock blasted to a new high above 200. A few months ago on The Bottom Line, when the stock was about 150, we did a segment saying, how high can it go? Because it didn't seem like it could go any higher. I think our projection at that point was 200, so here we are. So what does it mean going forward? The big thesis on Netflix is that Netflix is a modern TV network. It's just simply better than legacy TV networks. You can watch what you want to watch, wherever you want to watch it, whenever you want to watch it. You can sign up your entire family. At least our household, there are often 2 or 3 Netflix programs being consumed at one time. It's very different from television. And this is happening now all over the world, and a lot of Netflix's growth is coming from international, where they made big investments many years ago. From a high level, you can certainly say this is another great example of a company avoiding near-term profitability, investing a huge amount in long-term growth, and getting amply rewarded for it. And personally, I would say this is a suggestion to the rest of CEOs and companies out there that you can do that you don't have to maximize profit every quarter. But back to Netflix. How high can it go? At 200, the company has about an $85 billion market capitalization. It now dwarfs Viacom, CBS. It's bigger than Time Warner. It's now about a half of a Disney, which is the sole remaining massive legacy content player, smaller than Comcast, tiny fraction of Facebook and Google. But how high can it go? I think the way to think about it is at some point, Netflix will trade on a multiple of EBITDA, just like every other media company. To support a $100 billion market capitalization, it would have to have, say, 7 to 8 billion of EBITDA. It would trade at something like 15 to 20 times that. So where are they now? Well, they now have about 8 billion of revenue. So you are looking way into the future to get to 7 to 8 billion of EBITDA. On the other hand, you ask, what is it that's going to stop Netflix now that they are growing so fast internationally, now that they can invest more in content every year than every other network, including ESPN? Their projection for next year is 8 billion. There's no reason that as they grow, that annual content investment can't get even bigger. So there's really no limit on it there. The limit is how many people around the world can afford to pay for Netflix every month. Certainly there's a long way to go from now, but as the numbers get bigger, harder to justify, and at some point the stock will trade at a reasonable EBITDA multiple, just like every other company. Sarah, what do you think?
Well, I think that you point out a good thing about the content. It does seem to be all about that. And for me, they just increased their pricing by $1, $2 at the higher level, because I, like you, usually have more than 2 screens with Netflix at my house at a time. And I think that there's a lot more room that they could go, at least at pricing in the US, which isn't a lot of their subscribers, but there is upside. Right now, a lot of us are paying for we're paying for cable and Netflix is a bargain for us at this price.
That's right. There's definitely pricing power, I think, up from where they are now in the US. There certainly is the ability to offer family plans. We were talking earlier and you said, on the merchandise side, Netflix still can't compete with Disney. They don't have all the kids stuff. And I would say, they don't have all the kids stuff yet.
Yeah, I watched Troll Hunters.
There is no reason for them not to go into the kids stuff at some point.
Yeah, I think, and the merchandising thing is just fun because they sort of announced it during their earnings call by putting on the Stranger Things Christmas light sweaters, which are adorable, and I would definitely get one. But
adorable is a charitable word that I have not heard until now about those sweaters.
Yeah, I do like them. I think that they're funny. But with Disney, I think it's at some 56 billion in merchandising dollars. I don't see that for Netflix. Or, that seems like a stretch. And Nickelodeon's a lot further below that. And a lot of that is kid stuff.
But this dynamic, the ability to continue to spend more and more every year on content and thereby have a good library for potentially every human being on the planet, is a powerful model. And so it's very hard to sit here and say, okay, they can never get to a level that would justify this.
Yeah, I mean, for merchandising, but I think that for content, I completely agree. I think that they're spending more than anybody else on content, and they're getting that pricing power because of it. And Scott Galloway thinks that they could be the next $300 billion company. I don't know, what do you think?
Only 3 to 4x from here. I would say anything is possible. It's a very scalable model, but boy, on the EBITDA side, do they have a lot of growing to do to justify that.
Financial stocks have been the best performing sector over the last month, even after pulling back a little bit this week. And JP Morgan, Goldman Sachs, Bank of America, Citigroup, Morgan Stanley, all the big banks, all reported better than expected results this week. And even though, well, financials are probably responding more to the trajectory of interest rates than anything else, we do see a lot of bullish sentiment and positive positioning in the financial sector right now. So I want to share an insight from Matt Fruhan, the portfolio manager of the Fidelity Large Cap Stock Fund, who's been significantly overweight the financial sector over the last few years. And earlier this year, he said, in my opinion, this sector has remained out of favor for a long time, and the market had been undervaluing the earnings potential of many companies within this category. He said this outsized position hurt his fund performance relative to other funds. However, around the middle of 2016, financial stocks began to climb as signs of economic growth and inflation became increasingly clear. He says the rebound accelerated after the election, and it seems that everybody else is on board now. So we hope to talk to Matt sometime in the next few weeks. I'm here with Richard Turnell, the BlackRock Global Chief Investment Strategist. Thanks for joining me.
Great to be here.
So after looking over a bunch of your research notes, you seem to be bullish on almost everything.
We're certainly bullish on stocks, on risk assets right now, that's right.
And so just to jump right in there, how do you feel about valuations? A lot of people, and we've been talking a lot about valuations, seem really high for equities.
So the market's gone up a long way, and that's making people nervous. But when people look at valuations, we think they're too concerned, actually. When we look at the valuations of most parts of the stock market today, we think they're reasonable. And importantly, when you think about what's the right value or the fair value for the stock market, you have to think about what's the economic environment we're in and what's the interest rate environment we're in. And actually, in an environment of sustained economic growth and low interest rates, relatively high valuations can be supported for some time. So actually, we're much less concerned about valuations than many others. Although what we would say is that there are parts of the market which do look more highly valued. So the US market looks more expensive than many international markets, for example. So whilst we think the US market can do well, actually we see more upside in some of the international markets today.
And within the U.S. market, you still are you seeing opportunities there as well?
Yeah, we absolutely see opportunities within the U.S. market, and actually, the economic environment in the U.S. is very attractive. We see the Fed gradually raising interest rates going forward, and that's an environment which is very good news for technology stocks. It's also very good news for financial stocks, which do very well in an environment of gradually rising interest rates over time. So we prefer those two sectors. It's not so good for some sectors such as consumer staples, some of the more defensive bond proxies, which I think are going to struggle to keep up in a rising interest rate environment.
And are you concerned at all about the Fed unwinding its balance sheet and what the valuations will look like when interest rates start rising?
So one of the big risks to markets is that we have I feel like a policy mistake, that the Fed raises interest rates much more aggressively than the market anticipates, unwinds its balance sheet much more aggressively, and we have a repeat of the taper tantrum. And that's something that many investors, many of our clients have been worried about for some time. We think the risk of that scenario is quite low, and it's quite low because the Fed has been extremely deliberate in signaling what it's going to do. So the Fed has now started the process of reducing its balance sheet, but it's done that in a way where actually the market has been extremely strong through that process. And that's because the Fed has signaled the move well in advance. And really the only piece of uncertainty there is what the end game is. We can see the path for balance sheet reduction, but we don't know quite how far that will go. Our expectations on interest rates are that the Fed actually will end up doing more than the market's currently pricing in. So the market today is only pricing in around 2 interest rate hikes between now and the end of next year. We actually think the Fed will do what it's telling us it's going to do, which is raise interest rates up to 4 times over that period. That could create some volatility, but it's still a very gradual path of interest rate hikes over time. So in that scenario, again, we think the equity market can continue to make good gains.
And even if there is a little bit of volatility, you still see volatility staying, that it can stay low for a long time. And I know a lot of people don't necessarily agree with that.
Yeah, so we're in a very low volatility environment right now, and many people have seen that low volatility as a sign of complacency or a sign that you should sell equities and take profits. And purely statistically, that's just not the case. If you sold every time you're in a low volatility environment, you miss a huge amount of upside. The low volatility environment we're in today reflects the very stable economic environment we're in. So the economic data is incredibly stable. It's low volatility economic data. We're somewhere in the middle of a very long expansion. So while that continues, we think the low volatility regime will continue. That's an environment where you're generally being paid to take risk. Look at, there are areas of the market you're being paid more than others to take risk. And it's an area where you effectively buy the dips. It's not that you won't get dips. Of course there will be. There'll inherently be turmoil in the market. There'll be drawdowns. But in these low volatility regimes, you should be buying those dips rather than panicking and selling out.
You think we're somewhere in the middle of this economic expansion and not towards the peak of it?
Yeah, so I think one of the notable features of the cycle is it's been extremely long. So we're now in the 8th year of the expansion. And for my entire career, the average length of an economic expansion has been around 8 years. So many people...
So why do you think it's not about to end?
Because recessions don't start on a clock. You shouldn't measure the length of a cycle in years. You measure it in terms of the excesses that are building up in the economy, to what extent is excess capacity being consumed. So when you adjust this cycle for the fact that it's been one of the slowest cycles we've seen in economic history, actually, you come to the conclusion that rather than being at the end of the cycle, we're somewhere in the middle. And actually, the time to the next recession could be measured potentially in years. So we feel that we've got some way to run.
And why do you feel like we're somewhere in the middle? Is it because of wage inflation?
What you're not seeing is any of the signs of excess in the economy that would typically build up if we're towards the end of the cycle. So we don't see that in the labor market today. So you're right, wage inflation is low. We don't see that in broader consumer prices. So we think there's some upside potentially to inflation going forward, but we're still in a very benign price environment. And we don't see it in terms of leverage. We think about the signs of excess leverage that built up towards the end of the last cycle. We see very few signs. See some pockets of that, areas like auto loans, but you don't see that broad increase in leverage, which would flash a red warning sign that perhaps we're close to the end of the cycle.
And you like all of the equity factors right now. You like value, you like momentum.
Well, we don't like all. Well, we broadly think that factors are a good thing to have exposure to. That typically factors, if you're patient, will drive excess return over time. But the two factors we prefer in this environment are the two you mentioned. We think momentum typically does well. When you're in this period of sustained expansion, winners typically keep winning. And when we look at how expensive momentum stocks are right now, we come to the conclusion that they're not expensive. And when you look at how crowded momentum has become, actually, contrary to sort of many people's beliefs, actually momentum is very diverse right now. It's not all about a handful of tech stocks. Actually, you see great momentum in financial stocks, in many industrial stocks, in many materials stocks right now. So it's a very diverse group of stocks. So we think momentum can continue to run. And value typically does well in this phase of the cycle as well. And that's because that value is typically associated with economic growth. It typically does well when interest rates gradually rise. So we'd focus on momentum and value. On the other side of that, I think factors like minimum volatility, low volatility stocks, we think they may struggle. They typically do less well in this phase of the cycle.
Great. And is there anything else that you think people are not getting paid for all the risk that they're taking?
Well, the one I'm a little bit more cautious on right now is small cap stocks. They've done extremely well. I would say there's a lot of hope priced into US small cap stocks today, hope around corporate tax cuts in particular. So the Russell 2000, for example, is now trading around 25 times forward earnings. Those forward earnings themselves imply something in the region of 20% earnings increases over the next 12 months, so a lot of hope that we're going to get significant tax cuts. So that's an area I'd say that there's a lot in the price. Whereas if we look at areas like emerging markets, which have also done well, actually valuations are much more compelling. I think investors there really are being paid for taking the risk.
Great, and so the economy will continue to expand, volatility can stay low, equities look good, mostly international. And how do you feel about Bitcoin?
So we've been looking a lot at particularly blockchain as a technology. So I'd say in BlackRock, we're starting to use blockchain. I think it's a technology which is going to get more and more adoption over time. But what that doesn't mean is that the value of Bitcoin and broader cryptocurrency should continue to go up and up. I would say that cryptocurrencies show many of the characteristics of a bubble right now, which is you've seen spectacular price increases. The main argument for buying them is that prices have risen and are therefore going to continue to rise over time. But there's no inherent right or wrong price for Bitcoin. So you can say, what's the fair value? I'm an investor. I like to think about what's the fair value. I can think about the fair value of stocks or the fair value of bonds. I think I can't answer the question of what's the fair value for Bitcoin or any cryptocurrency. And for that reason, I'm not an owner.
Great. Thank you so much, Richard.
My pleasure.
And moving on to very important corporate news. A few weeks ago, we shared with you a video of Jack Ma, the CEO of Alibaba, coming out at the company's all-hands meeting dressed secretly and then publicly as Michael Jackson and dancing to some tunes. We had some disagreement as to whether this was an incredibly motivating and cool thing to do or whether it was kind of humiliating. Well, we just wanted to let you know that Jack Ma has now upped his game. He is doing more than dancing. He is singing at new performances. And there is disagreement among the Business Insider team as to whether this is great. Sarah thinks he's great. Others think he's, quote, fully committed, and that is very commendable. But anyway, kudos to Jack Ma. I continue to be inspired.
I mean, I feel like everyone should decide for yourself. You have to listen to it. He is great. He's a talented singer. I feel like maybe he's using this as a launch pad for like what he really wants to do. He became this billionaire CEO just so he can break out into the world of music and theater. He is a triple threat.
Well done, Jack. That's it for The Bottom Line this week. I'm Henry Blodget. Thank you very much for joining us.
And thank you to Fidelity Investments, of course, for making the show possible, and to the NASDAQ for hosting us.
See you next week.